Understanding taxes in Canada and how much you really need to earn. Introduction. Many people in Canada earn money but do not fully understand how much tax they actually pay. Some say taxes are too high, some say they are reasonable, but very few people understand how the system actually works. Today we will clearly explain what types of taxes exist in Canada, how income tax works in Ontario, how much of your income is not taxed. If you earn $100, how much you keep and how much you must earn to support a household and save money. This is practical financial knowledge for every Canadian family. Part 1. Main types of taxes in Canada. There are several categories of taxes. First is income tax. This includes federal tax and provincial tax. Second is payroll deductions. Canada Pension Plan contributions. Employment insurance contributions. Third is sales tax. In Ontario, this is harmonized sales tax at 13%. Fourth is property tax paid to your municipality. Fifth is capital gains tax on profit from investments. Sixth is corporate tax for businesses. For a salaried individual, the main deductions are federal income tax, Ontario income tax, CPP EIHST, when spending money, property tax if you own a home. Part 2. How income tax works. Canada has a progressive tax system. This means you do not pay one flat rate on all income. You pay different rates on different portions of your income. For 2026 approximately, federal tax up to about $55,000 is taxed at 15%. The next portion is taxed at 20.5%. Ontario provincial tax up to about $51,000 is taxed at 5.05%. The next portion is taxed at 9.15%. You only pay the higher rate on the portion above the bracket limit. PRT 3. What amount is not taxed? Every person has a basic personal amount. Federally, this is roughly $15,000. Ontario also provides a basic amount. This means if someone earns below around $15,000 annually, they pay little or no income tax. There are also credits for seniors, spouses, disabilities, and medical expenses. PRT 4. If you earn $100, let us assume middle income employment. From $100 gross income, income tax may be around $22, CPP about $6, EI about $1.5, total deductions around $29 to $30, take home about $70. When that $70 is spent, 13% HST applies to many purchases, so real purchasing power reduces further. PRT 5. Real household expenses. Example, let us examine a household budget. Mortgage $2,600, car $900, groceries $1,500, gas $500, utilities $1,000, miscellaneous $600, property tax $900, total monthly expenses equal $8,000. If this person wants to save $1,000 per month, total needed after tax is $9,000 per month. That equals $108,000 per year after tax. To take home $108,000 per year in Ontario, a person likely needs to earn approximately $145,000 to $155,000 gross income depending on deductions. So realistically around $15,000 annual income is required. Part 6. Ways to reduce tax legally. RRSP contributions reduce taxable income. TFSA allows tax-free growth. Principal residence has no capital gains tax. Pension income splitting for seniors, medical expense credits, charitable donation credits, child benefits are tax-free. Tax planning is not tax evasion. It is legal optimization. Part 7. Final thought. Taxes fund healthcare, roads, education, pensions, and security. But understanding taxation is essential for financial independence. Income alone is not enough. You must understand what you keep after tax. Financial planning begins with clarity. Thank you.